guys, welcome back. My name is Leland Baptist. I am one of the private bankers with Lee Chandler, and today we're going to talk about something very, very important. We're going to talk about how to assume mortgages, all right? If you're not sure what that is, a brief description of assuming a mortgage just means that you take on the responsibility of a property or properties, and in exchange for that, the owner at that time will also go ahead and give you ownership to that particular property, all right? Now, one of the other benefits with that is that you're able to assume or take on the responsibility of a property with very little resources out of pocket. So that means very little equity injections and so forth, okay? Now, the reason that someone may be interested in allowing you to assume their mortgage, or especially their property, is because either they're moving, they're in dire straits, possibly they're having bad management for that particular property. This can happen for commercial property as well as residential. Today, we're going to speak on mainly the process for residential. It's a little easier when it comes to doing it for commercial, so it's a lot more difficult for residential depending on what type of mortgage instrument is attached to the property. So we're going to kind of go over the gist of it, and if you guys have any questions, please comment below and I'll go in more detail. Alright, so we're first going to start over here to the left-hand side. So the very, very first, or the primary important thing when it comes to assuming a mortgage is really figuring out whether or not the seller, the individual who is currently on the mortgage, the person who has the house that is technically deeded to them, really just want to see if they are interested in allowing you to assume the mortgage. Now, most people would actually consider this to be seller financing. Most people would consider this to be seller financing because most are not familiar with assuming a mortgage. Essentially, what you're doing though is you are taking over the property in conjunction with the mortgage. So it's like a wrap, or people may be familiar with a wraparound and so forth. So if someone's looking just to walk away from that particular property, commercial or residential, they could be a good candidate. Now, the other thing too is that you have to, at some point in time, receive a quit claim. You can do this one of two ways. You could go about filing a quit claim and recording it yourself at your local county office, your county recorder's office, or you can go to a local title company and they will actually facilitate the closing of the transaction. Like I just mentioned earlier, when you speak with your title agent, you're going to use the verbiage or the jargon of a wrap, and not necessarily assuming a mortgage, okay? The third thing is certain sellers some people are more motivated than others. And if someone is not as motivated to just simply walk away, then at that point you want to make sure you have some type of payment agreement or a promissory note in hand for the individual. So the promissory note could say anything. It could be $1,500, it could be $15,000. It solely depends on the transaction, the individual, and their motivation, okay? And the last thing that's important too is power of attorney. The reason that you have to have power of attorney for most mortgage assumptions or wraps is because you want to be able to speak with the bank on behalf of that seller or that individual, okay? So think about this. If you're doing this, if you're doing a wrap or assuming a mortgage, at some point in time you're going to have to pay the mortgage, right? You're going to have to pay the taxes, the insurance, and so forth. You're going to need power of attorney, and all these documents have to be notarized. You're going to need power of attorney so that you're able to call the bank on that person's behalf. So now you're able to negotiate or pay the bank and so forth, make the monthly payments, catch the property up or the mortgage up on the payments and so forth. So these items are key. So I'm going to say it one more time. A quit claim, all right? A promissory note, if necessary, depending on the motivation. And the last but not least, also power of attorney, all right? Once you have that in place, at that point, you can begin to go ahead and get in contact with that particular lender or that particular bank. Now, most individuals who have a mortgage on properties, they normally have all the paperwork. If the seller does not have all the paperwork, at that point you can contact the bank directly on behalf of this individual, the seller. All right. Once that happens, you're going to request. You can say, "Hey, listen, I need to have a full documentation of the mortgage, right? I need to have full documentation of the mortgage and the note." And what you're looking for is you're looking for clauses. All right. Clauses, and you're also looking for a word that says assumption. Now, I can tell you this: for most FHA mortgages, assumptions, you will not find an assumption clause. All right. And if you do find anything about assumptions, it's going to say no. All right. But there's still a way around that as well. So don't fret about that. Okay. But what you want to do is you want to go ahead, contact the bank, and get the entire mortgage or loan documents. Okay. Now the mortgage normally is going to be 40 plus pages, depending on if it's an FHA, it's going to be pretty lengthy. If it's conventional, not as lengthy. If it's commercial real estate, normally those are like 5 or 10 pages. Okay. So the document may be this small or maybe this big. You need to take time out and look through that document. If if you're skimming through it, then at least go through the table of contents and look for anything in reference to assuming that loan. Okay. Now, the third thing you want to do is you want to look to find out what is the late or grace period for that particular loan. All right. Every loan is different, especially if it's commercial real estate. But if it's residential, normally your grace period is going to be a 15-day window. So what that means is, if the mortgage payment is due on the 1st, it may be considered late by the 3rd or the 5th. Okay. But they'll give you a grace period up until the 15th. So that means that although it may be considered as late on the 3rd or 4th or 5th, they may not apply any of the late rules or standards to that individual or that seller until the 15th. Now, once you find this out, it's going to help you out a lot. Okay. Because keep in mind, the only reason this individual is walking away from this property is because there has to be some kind of motivation and normally some type of distress attached to that property. So it's important for you to know how long you're able to stretch that grace period. Okay. And then last but not least, let's talk about getting around that assumption a little bit. Now, depending on how the mortgage is written, the clause is written, you'll find out that that most 99% of mortgages allow you. They won't allow you to assume if it's residential and it's FHA and so forth. But they will allow you to put that property in a trust. Okay. Now you'll have to look on your particular mortgage document to figure out what type of trust. It could be a living trust, it could be revocable trust. What type of trust is it? Okay. And when you have power of attorney, you're able to speak with the bank to find out exactly what type of trust is allowed. Once that takes place, you need to establish that trust, and you need to record it, and then at that point, you need to marry these two. Okay? You need to marry these two. Now, when you have a trust, you as the individual can then become the trustee of the trust, right? And then you're the trustee of that particular trust on behalf of the seller. Now, as a trustee, you have full control, depending on how you write it, right? Depending on how you write up the trust. You will have full control of the property and anything in reference to the property. So that means to sell the property, taxes, liens, you'll be in full control. One of the beautiful things with this is that you as the individual, you have control. But if something were to go wrong, you don't have all the liability on you. Technically, all the liability will actually be on the trust. Okay, the liability will not be on you as the trustee. You're looked at as more of a like a manager. I would basically say similar to you being like a portfolio manager or stock manager for let's say, I don't know, Charles Schwab or a huge brokerage. Okay. You're managing the portfolio or that trust. If that trust were to go under, you would still be unscathed. You'll still be alive. All right. So nothing bad would happen to you. Your credit wouldn't plummet. Nothing like that. All right. Only thing that would happen is that trust, which is an entity, which technically isn't even a person, that trust would then either be dissolved, revoked, foreclosed on, etc., etc. Okay. Now let's talk about servicing. All right. So when we talk about servicing, this is like super important. every mortgage company, every bank, every lender has a servicing company. And it's this servicing company's job normally to receive the payments that an individual makes. Those payments could have tied to it mortgage, taxes, insurance, and other things, right? PMI and so forth. So they're going to collect the payment, and they're normally going to collect the payment from you, the trustee of that trust. And then they're going to disperse those payments. They're going to disperse payments to the lender for their mortgage and interest. They're going to disperse payments to your local county for that property, for the taxes. And they're going to disperse payments to your insurance policy with your insurance agent, or whoever you have insurance with. Okay. And then normally what happens is that they will actually hold that money if it's not needed for taxes or whatever else. They'll hold that money in an escrow account until the agreed disbursement date. Okay. So you may have a county that says, hey, listen, only pay us, twice a year. Well, they'll hold that amount in an escrow account. Or you may have insurance that says, hey, only pay us once a year, right? Or only pay us monthly, whatever. And they'll hold that in an escrow account. When you gain power of attorney, you are then able to figure out how much is left in the escrow account, or you may say the kitty, right? Because what that means is that if you, and normally there's always money left in the escrow account, okay? Because of insurance and so forth. And what that means is that if this person was in distress, and if they were behind on their payments, let's say 2 months, if and when you catch them up, right, on their payments, there should be some type of money in the escrow account that will also benefit you. Now, sometimes you may have to wait, a couple months, maybe a year, 12 months, maybe 5 months, whatever, before you can gain access to the escrow account. But the benefit with that is that you're knowing that, hey, at the end of 5 months, you're going to have another take of cash to then apply to the mortgage or to the upkeep of the property. All right? So you always want to keep that in the back of your mind. So when it comes to the residentials. So now that you've, also something's important. When you gain power of attorney, and then you let the lender know that you are the trustee of this individual's trust, okay? They will be willing to negotiate with you as far as a payment arrangement, all right? Because the way they're viewing it is they're viewing it as someone is coming in, someone is stepping in, someone's being the quote-unquote white knight for this transaction or for this deal or for this property, this asset. And now they're saying, hey, this individual is saying that they want to go ahead and get things back on track, right? And you're saying, hey, this is why I'm a trustee, because I want to make sure that this asset doesn't go under or this asset's no longer in distress. So at that point, you're able to negotiate with the lender or with the bank to go ahead and have different terms, and also catch back on those payments. So now that we have that established, let's go ahead and talk about increasing the income for this particular asset. Okay. Like I mentioned earlier, this could be a threeplex, it could be a commercial building, it could be a residential building, whatever it is. All right. There's going to be a few ways that you're going to be able to increase your income. Keep in mind, there's one thing that is going to remain constant, and that one thing is going to be your mortgage. That mortgage is going to remain constant unless you've negotiated special payback periods and payback amounts with the particular lender. Okay. So the first thing here is we can focus on is taxes. Now, depending on your county, some counties are lenient, some counties are not. But you can, in fact, actually challenge taxes, and it's not going to be an immediate fix. What may happen is that you may have to wait to the next cycle. But once that next cycle takes place, you'll be able to have a lower taxation, okay, lower taxes. And that doesn't always work, but it's a strategy that you can use, okay? Because what that will do in the long term is that it's going to increase your escrow account. You're going to end up either getting that money back or have that money applied towards your monthly mortgage, okay? Second thing is insurance. When you're a power of attorney and you're the trustee over this property and over this loan, you also have the ability to see who the insurance is with. And one of the greatest benefits you can do is if you work closely with an insurance agent, you can have them look at you at that existing loan or that existing insurance policy, and you can actually speak with a licensed insurance broker and have that individual shop for you a cheaper insurance policy based on the requirements that the lender has. Okay, so if it meets the requirements for the lender and it's cheaper, that's a great way for you to save additional money. All right, because keep in mind, your one payment is going to the servicing company, and then the servicing company is then putting it in an escrow account, which then disperses it to that insurance policy. Well, if this is going to be cheaper this time, what will happen next year or the next month is that eventually your payment is going to be less. Okay, and of course that increases income for you if you're renting this property out. So, which brings us to number 3, which is renting. All right, which is renting. Now, I've seen it done multiple ways. I've done it different ways as well. You can either rent the property out to individuals, all right, which means you have leases, or you can actually do what's called a lease option for that particular property. All right, as the trustee of that asset, as a trustee of that trust, you can lease that property out. As a trustee of that trust, depending on how you have your trust written up, you can sell that asset. Okay, you have the full control as if you built it yourself. You have the full control. All right, so you can lease that property out. You can lease it, you can rent it, you can do a lease option, you can sell it if you wanted to, all that stuff. Okay, and real quick, the reason that most people don't end up selling the property when they go this route initially is because unless the area has greatly appreciated, it's not worth selling. Okay, and the other thing too is keep in mind this person walked away for a reason. All right, if this property if this property's value was let's say $200,000 and it had a loan of let's say $50,000, this person wouldn't walk away. This person would either keep it or they would just sell it, all right, for profit. Now, if you run into someone who is ignorant to their capital stack, then then by all means, I would just go ahead and sell that. But normally what happens is you run into a situation where the property is worth $300,000 and the mortgage is $280,000, right? And unless you sold it at $300,000 and the market's at that same price, all that stuff, it wouldn't be worth selling it, honestly, because you have capital gains and all that crap. All right, so the next thing is to increase income will be your deposits. So we're talking about rental deposits now and non-refundable deposits. Okay, it's a good way to increase income. And then finally, down payment. If someone's doing a lease option or a lease option to purchase, then your down payment may be a lot bigger. Your down payment could be $5,000. It could be $10,000. Okay. At that point, what that does for you is that allows you to go ahead and catch up on those payments that property is behind. Hopefully, that's what you'll do. If not, it just means additional cash for you as a trustee or as a trust. Okay. Alright, so this particular asset, how are you going to maintain it? Well, if you're doing a lease option, depending on how you write the lease option, you could have it to where the tenant takes care of the maintenance. Alright, so there are some leases and some lease options where the tenant cuts the grass, where the tenant cleans the gutters, where the tenant takes out the trash and all this stuff. Okay, whatever you put in paper, and if 2 people agree on it, that's what it is, okay? As long as it's ethical and it's not, anything crazy. But if it's in your lease or your lease option that the tenant is going to cut the grass, then great. Because certain things can help save on property management if you don't want to use it. I would definitely suggest that you use a licensed, trustworthy property management company or manager. But as a backup, I would try to put as many things in your lease or your lease option to where the tenant would actually take care of that asset, okay? And then last but not least, we have online management. I want to say online management here primarily for payments, okay? So instead of having someone come to your office and drop off checks and people are all in your business at work and things like that, I would suggest that you go ahead and have online management to where they have a portal and they can go ahead and pay money directly into that portal. Now you can use PayPal, You can use Appfolio, which is a good app for real estate holders, and you can use tons of other things. Okay, you can be as creative and as you want to. Just make sure that this individual, when they pay, they receive a confirmation and a receipt. All right. Any questions?
So you're saying if the seller is just walking away, you don't necessarily have to go through the same steps. Is that what you're saying?
Well, you want to go through these steps. The only thing is that if the seller is walking away,
Right.
and they are literally like walking away, you most likely you don't need a promissory note.
Okay.
Because there's no need to promise them anything or to give them any money if they really just want to walk away.
Okay.
And you'll meet people who honestly just want to walk away. This could be someone who's moving to another state, who just got divorced. Could be someone who, maybe they have a property in Indiana, but their grandfather is sick in Florida and they really need to go, and they don't want the headache of taking care of that property. It could be something to where they really want to leave, but they're afraid that if they leave, who's going to pay that mortgage, right? And that's a fear too. They could be afraid that they can't do both mortgage payments and all that stuff. And so a negotiation tactic could be, hey, listen, I can take care of this mortgage, but if I pay you this amount you want today down or whatever, I'm not going to be able to pay the mortgage and give you money at the same time. So because of that, it has to be either or. And it's in our best interest. It's in our best interest that I go ahead and take that money and use it to pay your mortgage. That way, there's no scaves on your record and things like that. So you can use that as a negotiation tactic too.
Makes sense.
And what are the questions like you have?
That was really the biggest one. I was trying to figure out the difference. Somebody's just walking away, or if you know what I'm saying?
Yeah. And I know it sounds weird. People actually walk away. Yeah, I know it sounds weird. Because what will happen is you'll run into something where it'll be a husband and wife, and the wife and the kids are in Illinois, and the husband is only staying in Indiana solely because he has to pay the mortgage. And he wants to make sure he takes care of the property, right? And because they're so strapped for cash that he can't pay anyone to take care of the lawn and all that stuff. So he'll just live in it or whatever, while they're separated.
Right.
She could have got a new job and he didn't, that kind of thing. So yeah, you'd be surprised. And so he's like, well, hey, we didn't move because I have a job here and I moved there. I want to have a job there. And then if I do move there, we can't do both mortgages or both rent payments and all that stuff. So you'll be surprised about that.
So, I have one question. So the situation with the bank, do you need to do that first before you decide to go forward with assuming a mortgage?
So here's a cool thing. Everything here, even though it could be in writing, this is contingent upon being able to assume it. Because we could write up a promissory note with this seller, and it could be in reference to this property. But if the bank's not going to allow it, it wouldn't mean anything.
Right.
You know what I mean? So normally people have their mortgage documents.
Okay.
If they don't have their mortgage documents, you are going to have to get those mortgage documents. The only way a bank is going to allow you to, what's so weird about lenders is that lenders will allow you to pay someone's mortgage, like no questions asked. I could call Joe Blow. I could call Joe Blow in Greenwood, and I could pay his mortgage today, and a lender would not care. Money's good, great, fantastic. But if I wanted to ask about Joe Blow's mortgage history or his most recent payment, right, which would be mine, they wouldn't give me that information unless I had power of attorney,
right,
or unless I was a trustee of his trust.
Okay.
Super weird, right? So the bank will allow you to pay. Basically, the bank will take your money, but they won't give you information unless it's in written format. So you would have to have this first before you can even find out what's going on here.
Okay.
Unless this person has those documents.
Okay.
And you know, if it's someone who doesn't even have these documents, I'm telling you, this person is more willing to walk away than anything.